Have you ever wondered why billionaires are technically broke? I'm not joking. If you looked at Jeff Bezos' checking account, it might have less money in it than yours. Same with Warren Buffett, Elon Musk, most of the wealthiest people on the planet. But here's what nobody tells you. They're not actually broke. They're just not keeping their wealth in the same place you are. Here at Simple Money, we've studied the financial behaviors of wealthy individuals. And today, I'm going to reveal why rich people avoid keeping money in banks, and why you should probably start thinking the same way. This isn't about being rich, it's about understanding how money actually works. Here's what's really happening with your money in the bank. Let's say you've got $50,000 sitting in your checking account. Maybe you're saving for a house, or building an emergency fund, or you just don't know what else to do with it. You feel responsible. That money is safe, FDIC insured, right there when you need it. But here's the uncomfortable truth. That money is working, just not for you. The bank takes your $50,000. They pay you maybe 0.5% interest if you're lucky. That's $250 a year. Then the bank turns around and lends your money to someone else. Maybe as a mortgage at 6%, maybe as a business loan at 8%, maybe as credit card debt at 20%. They're making thousands of dollars off your money while paying you hundreds and keeping the difference. Think about it this way. Imagine you own a car, but instead of driving it yourself, you let someone else drive it. They use it to run a taxi service, make tons of money, then pay you $20 a month for the privilege. You'd never agree to that deal, right? That's a terrible arrangement. But that's exactly what you're doing when you keep large amounts of money in a bank account. You're letting someone else profit from your capital while you get table scraps. Now, don't get me wrong, banks serve a purpose. You need checking accounts for daily transactions. Some emergency cash makes sense. But wealthy people understand something crucial. Cash sitting in a bank is idle capital. It's potential energy that's not being used. It's a tool left in the toolbox instead of being put to work. And here's what makes this particularly painful. While your money sits idle, earning almost nothing, inflation is eating away at its value. Every single day, that $50,000 loses about 3% of its purchasing power annually to inflation. That's $1,500 a year in real losses. So you're earning $250 in interest, losing $1,500 to inflation. Net result, you're getting poorer by $1,250 a year just for being responsible and keeping money in the bank. This is the game rich people refuse to play, and once you understand why, you'll never look at your bank account the same way. Let me introduce you to what I call the opportunity cost trap. This is the first and most important concept. Every dollar sitting in your bank account is a dollar not working for you somewhere else. And the gap between what that dollar earns in the bank versus what it could earn elsewhere is staggering. Here's why this matters. Rich people don't think about money in terms of dollars. They think about it in terms of what those dollars could generate. A middle-class person sees $10,000 as $10,000. A wealthy person sees $10,000 as the future income stream that money could produce. Let me make this concrete. $10,000 in a bank account earning 0.5% will give you $50 a year. Before taxes, that same $10,000 invested in dividend-paying stocks might generate $400 a year, and those dividends typically grow over time. Or invested in real estate, it might generate $800 a year in rental income plus property appreciation. Or, used as capital to start a small side business, it might generate several $1,000s a year in profit. The bank account gives you $50, other options give you hundreds or thousands. That difference is the opportunity cost. Think about it this way. Imagine you have a magic goose that lays golden eggs, but you keep it locked in a cage where it can barely move. It lays one tiny egg per year. Meanwhile, if you let that goose roam in a proper environment, it could lay dozens of eggs. Feed it well, care for it properly, and it might even have baby geese that lay more eggs. Your money is the goose. The bank account is the tiny cage. The goose survives, but it's not thriving, not reaching its potential. Rich people refuse to cage their geese. They put every dollar to work in environments where it can multiply, generate returns, create wealth. Here's a specific example. Warren Buffett keeps almost no money in cash. He said his cash position makes him uncomfortable because it's not generating returns. Instead, his money is constantly deployed, buying companies, investing in stocks, acquiring assets. Every dollar has a job, every dollar is working. Meanwhile, the average person has months or even years of expenses sitting in checking accounts, doing nothing, earning nothing, slowly losing value to inflation. This is the opportunity cost trap. You feel safe because you can see your money, but you're actually sacrificing enormous potential returns for the comfort of liquidity you probably don't even need. The second concept I call the liquidity illusion. This one is particularly insidious because it makes you think you're being smart when you're actually being short-sighted. Here's what happens. People keep money in banks because they want immediate access, liquidity, the ability to spend it right now if needed. But here's the psychological trick. The easier it is to access your money, the more likely you are to spend it on things that don't matter. And the more money you keep liquid, the less you allow it to grow. Let me explain. When you have $30,000 sitting in a checking account, it's mentally available for anything. A new car catches your eye, you could afford it. Spontaneous vacation, the money's right there. That psychological availability is dangerous. It creates what I call lifestyle inflation pressure. The constant temptation to upgrade your life because you can technically afford it. Rich people understand this. So they make their wealth deliberately illiquid, not locked away forever, just not sitting in easily accessible cash. Think about it this way. Imagine you're trying to diet. You could keep cookies in a jar on your kitchen counter, easy access. You tell yourself you'll show restraint, or you could keep cookies at the back of your pantry in a sealed container behind other items. Still accessible if you really want them, but not immediately tempting. Which scenario helps you stick to your diet? Obviously, the second one. The friction matters. That's exactly what wealthy people do with money. They add friction, put it in investments, real estate, businesses, assets that require effort to liquidate. This serves two purposes. First, it prevents impulsive spending. You can't easily blow $50,000 on a boat when that money is invested in index funds. Second, and more importantly, it forces the money to work, to generate returns, to compound over time. Here's a real example. Let's say you keep $20,000 in your checking account for emergencies. How often do you actually need $20,000 immediately? Probably never. Most emergencies cost a few $1,000s max. A car repair, medical bill, unexpected expense. You could keep $5,000 truly liquid, put another $5,000 in a money market fund that you could access in 2 days, and invest the final $10,000 where it actually grows. Now, your emergency fund is still there, but only a fraction is sitting idle. The rest is working for you. Rich people structure everything this way. They keep enough cash for immediate needs, then they put everything else to work, because they understand that liquidity has a cost, and that cost is opportunity. The irony is that making your money less accessible often makes you wealthier, not poorer, because you stop spending it on things that don't matter, and you start letting it compound in things that do. Here's the third pattern. I call it the asset shift. This explains the fundamental difference between how middle-class people and wealthy people store value. Middle-class people store value in currency. Wealthy people store value in assets, and that distinction changes everything. Here's what I mean. When you get a paycheck, you probably deposit it in your bank. Your wealth exists as numbers in an account, dollars, currency. When a wealthy person generates income, they immediately convert it into assets, stocks, real estate, businesses, commodities, things that hold or increase value over time. The difference isn't just semantic. It's mathematical. Currency is guaranteed to lose value over time because of inflation. Assets have the potential to gain value faster than inflation. Over decades, this gap becomes enormous. Let me give you a concrete comparison. In 1970, $100,000 in a bank account was a fortune. Adjusted for inflation, it's equivalent to about $700,000 today. But if you kept that $100,000 in cash over 50 years, you'd still have $100,000, which buys what about $14,000 bought in 1970. You'd have lost 86% of your purchasing power. just by holding currency. Now imagine instead you use that $100,000 to buy rental properties in 1970, or stocks, or starting a business. Those assets would have appreciated, generated income, compounded. That same $100,000 would likely be worth several million today. Same starting capital, wildly different outcomes. All because of one decision: store value in currency or store value in assets. Think about it this way. Imagine you're a squirrel preparing for winter. You could store acorns in a pile, just stack them up, count them, feel good about your pile. But over time, some acorns rot. Some get eaten by bugs. Some sprout into trees and become useless as food. Your pile shrinks, or you could plant those acorns. Grow oak trees. Those trees produce more acorns every year. You have a renewable, growing food source instead of a shrinking pile. Currency is the pile of acorns. Assets are the oak trees. One depletes, the other regenerates and grows. Wealthy people learn this lesson early. They view cash as a temporary state. Money flows through their bank accounts on its way to becoming assets. They're not hoarding dollars. They're accumulating things that produce dollars. Real estate that generates rent, stocks that pay dividends, businesses that generate profit. This is why you hear stories about billionaires who are quote unquote cash poor. They own billions in assets, but they don't have billions sitting in checking accounts because they understand that assets appreciate while currency depreciates. Assets work while currency sits idle. Assets compound while currency stagnates. The middle class keeps their wealth in the bank, the rich keep their wealth in assets, and over time, that simple difference creates a massive wealth gap. The fourth concept is what I call the leverage game. This one might be the most counterintuitive, but it's also one of the most powerful tools wealthy people use. Here's what happens. Rich people don't just avoid keeping money in banks, they actively borrow money from banks, even when they could pay cash. Wait, what? They have millions, but they take out loans? That sounds backwards, but here's why it makes perfect sense. When you borrow money at 4% and invest it in assets returning 8%, you're making money on borrowed capital. This is called leverage, and wealthy people are masters at using it. Let me give you a simple example. A rich person wants to buy a rental property worth $500,000. They could pay cash. They have the money. Instead, they put down $100,000, borrow $400,000 at 4% interest. Now they own the property but still have $400,000 in cash. They use that $400,000 to buy 4 more properties the same way. Now they control $2.5 million in real estate with their original $500,000. If real estate appreciates at 4% annually, their $2.5 million in properties gains $100,000 in value per year. All while the rental income covers the mortgage payments. They turn $500,000 into $100,000 in annual returns. That's a 20% return just by using leverage. If they'd paid cash for one property, they'd only be making $20,000 per year in appreciation, a 4% return. Same starting capital, 5 times the returns, just by understanding how to use debt strategically. Think about it this way. Imagine you're offered a deal. Someone will lend you a bicycle for free. You can use that bicycle to deliver packages and earn $50 a day. The only condition is you pay them $10 a day to rent the bicycle. That's a no-brainer deal, right? You make 50, pay 10, keep 40. That's exactly what leverage does. You borrow capital cheaply, use it to generate higher returns, keep the difference. Banks understand this intimately. That's literally their entire business model. They borrow money from you at 0.5%, lend it out at 6%, keep the 5.5% spread. Rich people simply reverse the game. They borrow from banks at low rates, invest in assets with higher returns, keep the spread. Here's where this connects to not keeping money in banks. If you have $500,000 in a bank account, you can't use leverage. That money is just sitting there. But if you only keep $50,000 in the bank and invest the rest in assets, you can borrow against those assets when opportunities arise. Your money is working, and you still have access to capital through loans. This is why wealthy people keep minimal cash. They don't need cash reserves because they can access liquidity through credit lines. Home equity loans, portfolio margin loans, their assets are collateral. Banks will happily lend them money at low rates because they have valuable assets backing the loan. Meanwhile, someone with a large cash savings but no assets struggles to get approved for loans because banks don't see them as having real wealth. The paradox is wild. The person with $100,000 in the bank is seen as less creditworthy than the person with $10,000 in the bank and $300,000 in invested assets, because banks know that cash gets spent. But assets remain, appreciate, generate income. The fifth and final pattern is the tax efficiency advantage. This one reveals how keeping money in banks actually costs you more than just opportunity cost. It costs you tax efficiency. Here's what happens. Interest from savings accounts is taxed as ordinary income at your highest marginal tax rate. If you're in the 24% bracket, you lose almost a quarter of your interest to taxes. Meanwhile, wealthy people structure their holdings to minimize taxes. Long-term capital gains, qualified dividends, tax-deferred retirement accounts, tax-free municipal bonds. Let me break this down. You have $50,000 in a savings account earning 1%. That's $500 in interest. Taxed at 24%, you keep $380. After inflation at 3%, you're losing $1,500 in purchasing power, gaining $380 in after-tax interest. Net loss, $1,120. You literally paid money to keep money in the bank. That's insane. Now imagine that same $50,000 invested in index funds. Historical returns average about 10%. That's $5,000 per year. If you hold for over a year, it's taxed as long-term capital gains at 15%. You keep $4,250 after taxes. After inflation, you're still up about $2,750 in real terms. Same money. One scenario loses you over $1,000. The other scenario gains you almost $3,000. That's a $4,000 swing. Think about it this way. Imagine you have two jobs. Job A pays you $10 an hour, but the government takes $8 in taxes. You keep $2. Job B pays you $30 an hour, and the government takes $5 in taxes. You keep $25. Which job do you choose? Obviously, job B, more gross income and lower taxes. That's exactly the difference between keeping money in banks versus investing it in assets. Banks give you terrible returns that are heavily taxed. Investments give you better returns that are tax advantaged. Wealthy people obsess over tax efficiency, not because they're greedy, but because taxes are one of the biggest drags on wealth accumulation. If you can save $10,000 in taxes over a decade by structuring your wealth intelligently, that's $10,000 that can compound into $30,000 or $40,000 over the next 20 years. Small tax differences become enormous over time, just like small return differences. This is why rich people have accountants and financial advisors, not to evade taxes, to optimize their wealth structure so they keep more of what they earn. And step one of tax optimization is getting money out of savings accounts where it's taxed inefficiently and into assets where it can grow tax efficiently. Now, here's what nobody wants to admit, and this might make you uncomfortable. The traditional advice to keep money in savings accounts isn't neutral guidance. It serves the financial system's interests, not yours. Banks need your deposits. That's their raw material, the fuel that powers their lending business. So the entire financial industry reinforces the message. Save money, build emergency funds, keep cash reserves, be responsible. And to be clear, having some cash is responsible. But the amount they push you to keep, 3 to 6 months of expenses, often $50,000 or more, that's not for your benefit, that's for theirs. Think about what happens when millions of people keep large cash balances. Banks have enormous capital to lend. They pay you nothing, charge borrowers plenty, and profit from the spread. Meanwhile, you're told you're being responsible, prudent, safe, but you're actually funding the bank's profit engine while your wealth slowly erodes. Here's the truth that makes people uncomfortable. The path to wealth has never been through saving. It's always been through asset ownership. Every wealthy family in history got rich by owning things: land, businesses, resources, investments. Not by accumulating cash. Cash is what you use to buy assets. It's not the end goal itself. But we're taught from childhood to save money. Put it in the bank, watch it grow, be responsible. That advice keeps the financial system running smoothly. It keeps you in your place. It doesn't make you wealthy. Rich people figured this out. They use banks as tools, not as wealth storage. They understand that banks are designed to extract value from your capital, so they minimize how much value banks can extract. This is why there's such a stark difference between how rich people and middle-class people use banks. Middle-class people see banks as partners, places to store wealth, trusted institutions. Rich people see banks as service providers, necessary for transactions and strategic borrowing, nothing more. One group is trying to be a good customer, the other group is trying to be a smart business owner. And over decades, that mindset difference creates dramatically different outcomes. Let me tell you about Tom. Tom is 55 years old. He's worked hard his entire life, been responsible with money, saved diligently. Tom has $200,000 in his savings account. He's proud of this. It took decades to accumulate. He keeps it in the bank because it feels safe. Tom's account earns 0.5% interest. That's $1,000 per year. Before taxes, after taxes, he keeps about $700. Meanwhile, inflation at 3% means he needs $6,000 just to maintain purchasing power. Net result, Tom loses $5,300 in real wealth every single year, just by keeping his money in the bank. Over the last 20 years, Tom estimates he's kept an average of about $80,000 in savings. That money has earned maybe $12,000 in interest over 2 decades. But inflation has eroded about $48,000 in purchasing power. Tom's responsible savings behavior has cost him $36,000 in real terms. Meanwhile, the stock market roughly quadrupled over that same period. If Tom had invested that $80,000 average balance, it could be worth $320,000 today. Instead, he has whatever he has in the bank, minus the opportunity cost, minus the inflation losses, minus the tax drag. Tom did everything he was told to do: save money, keep it safe, be responsible, and he got punished for it financially. Now, Tom is approaching retirement. He's worried his savings aren't enough. He feels like he should have more given how hard he worked. He blames his salary, the economy, rising costs. He doesn't realize the problem was that he let his wealth sit idle for decades while inflation and opportunity costs ate it alive. Tom represents millions of people, hardworking, disciplined, responsible, and completely unaware that their wealth storage strategy is destroying value every single day. Now, let me tell you about Maria. Maria is also 55, similar career to Tom, similar income over the years, started with similar amounts to save, but Maria did something different. She keeps $10,000 in her checking account, enough for monthly expenses and small emergencies. She keeps another $10,000 in a money market fund for larger unexpected expenses, accessible within a day or two if needed. Everything else? Invested, index funds, rental property, retirement accounts. Her wealth exists as assets, not cash. 20 years ago, Maria had about $80,000 just like Tom, but instead of leaving it in a savings account, she invested it. Through consistent contributions and market returns, that money has grown to about $400,000. Not because Maria is a genius investor, just because she let the market do what markets do over time. Her money was working, growing, compounding, generating dividends, appreciating. Maria's returns averaged about 9% annually. After inflation and taxes, she still netted about 5% real returns per year. Over 20 years, that turned $80,000 into $400,000. Meanwhile, Tom's $80,000 stayed roughly flat in real terms. Maria has 5 times more wealth. Not because she earned more, not because she saved more, just because she understood that keeping money in banks destroys wealth over time. Here's the kicker. Maria actually feels more financially secure than Tom, even though Tom can access his money instantly, and Maria's wealth is in investments, because Maria knows her wealth is growing, compounding, working for her. Tom knows his wealth is stagnant, eroding, losing ground. The person with immediate liquidity feels anxious. The person with invested assets feels confident. That's the exact opposite of what you'd expect, but it reveals the deeper truth. Real security doesn't come from cash in the bank. It comes from assets that appreciate and generate income. Here's what most people don't realize, and this is the key to everything. The difference between Tom and Maria isn't about risk tolerance. It's not about financial sophistication. It's not about having secret knowledge. It's about understanding the purpose of money. Tom thinks money is for having, for accumulating, for storing. Maria understands money is for deploying, for working, for generating more money. Tom treats money like a trophy, something to collect and display, proof of his hard work. Maria treats money like a tool, something to put to use, a means to an end. And that fundamental difference in perspective creates completely different outcomes. Here's the reframe. Banks aren't wealth storage facilities, they're transaction processors. They facilitate moving money around, but they're terrible places to store value long term. Rich people figured this out generations ago. They keep minimal cash, they store their wealth in assets, they use banks as utilities, not as partners. The question isn't should you trust banks? It's whether you understand the cost of keeping large amounts of money in banks. That cost is enormous. Opportunity cost, inflation losses, tax inefficiency, it all adds up over time to massive wealth destruction. Every year you keep $50,000 in a savings account instead of investing it, you're probably losing about $3,000 to $5,000 in potential wealth growth. Over 20 years, that's $60,000 to $100,000 you'll never get back. Not because the market crashed, not because you made bad investments, simply because you chose safety over growth. The irony is that the safe choice actually guarantees you lose, while the risky choice gives you a fighting chance to win. And once you see this, you can't unsee it. Every dollar in your savings account becomes visible as wealth slowly dissolving. Potential energy wasted. Opportunity squandered. The opportunity cost trap, the liquidity illusion, the asset shift, the leverage game, the tax efficiency advantage. These aren't abstract concepts. They're the practical reasons why wealthy people refuse to keep significant money in banks. And they're patterns you can implement immediately, not because you're rich, but because you understand how wealth actually works. The question isn't whether banks are safe. They are. The question is whether safety is the same as prosperity. It's not. Tom chose safety and got slow financial erosion. Maria chose growth and got wealth accumulation. Same starting point, opposite outcomes. Because here's what I want you to understand. Rich people don't avoid banks because they're reckless. They avoid keeping money in banks because they're smart about opportunity cost. They know that every dollar sitting idle is a dollar not working, not compounding, not generating returns, not building wealth, and they refuse to let their capital sit idle just because it feels comfortable. Your savings account isn't protecting you. It's a slow leak in your financial boat, small enough that you don't notice, but steady enough that over decades, it sinks you. The wealthy plugged that leak. They put their money to work in assets, and they use banks as transaction tools, not as wealth storage. You can do the same thing, starting today, not with millions, with whatever you have right now. Keep enough cash for emergencies. Put everything else into assets that appreciate. Stop letting banks profit from your idle capital while you get nothing in return. The wealthy aren't keeping money in banks, and now you know why. The real question is whether you'll keep making the same mistake they stopped making decades ago. Your wealth is either growing or shrinking. There's no neutral, and bank accounts guarantee it's shrinking slowly, invisibly, but definitely. Rich people saw this truth and acted on it. The opportunity to do the same is sitting in your savings account right now, waiting for you to put it to work. The question is whether you will.